The gentleman from Texas, under the Speaker's announced policy of January 7, 1997, the gentleman from Texas, Mr. Paul, is recognized for 60 minutes as designee of the majority.
Thank you, Mr. Speaker. Mr. Speaker, we are now experiencing a worldwide financial crisis. It may yet prove to be the worst in all of history. There have been a lot of wringing of hands as to the cause, but the source of the problem is not a mystery. It is a currency-induced crisis. Although tax, spending, regulatory policies, and special interest cronyism compounds the problems, all nations of the world operate with a fiat monetary system. We have been operating with one for 27 years, and it has allowed the financial bubble to develop. Easy credit and artificially low interest rates start a chain reaction that by its very nature guarantees a future correction. Depending on the particulars of fiscal and monetary policy and political perceptions, the boom part of the cycle lasts for unpredictable lengths of time. The latter, bad consequences of inflating a currency are certain, no matter how beneficial the earlier ones seem. The dollar has played a major role in the worldwide financial bubble since the dollar is the reserve currency of the world. It is readily accepted and used to further inflate most other world currencies. Noted free market economist Ludwig von Mises astutely observed in 1940, quote, "No political party and no government has ever tried to consciously make a conscious deflationary effort. The unpopularity of deflation is evidenced by the fact that inflationists constantly talk of the evils of deflation in order to give their demands for inflation and credit expansion the appearance of justification." Close quote. Since we hear no talk of sound money, and we can be assured no government will deliberately deflate, we should remain vigilant against the politically popular policy of inflation, the deliberate debasement of the currency. Beneficiaries of easy credit demand, beneficiaries of easy credit demand the policy of currency inflation continue. Creating money and credit out of thin air gives the illusion of the perfect counterfeiter, appearing legal and helpful to many. The power to inflate a currency guarantees a lender of last resort for risky borrowing, domestic and international. It accommodates deficit spending, permitting spending on extravagant welfare programs and unwarranted international militarism. Something for everyone. The welfare poor like it, the welfare rich like it, the foreign welfare recipients like it. It seems everyone likes it until the artificial nature of the financial bubble becomes apparent, as it is now. Fiat money and its low interest rates cause malinvestment, overcapacity, rising prices in one industry or another, excessive debt, and over-speculation worldwide. We have had all of this. The current system has generated a nearly $30 trillion derivatives market. This is a modern-day phenomenon, having allowed a greater speculative binge than anything known in financial history. But the current crisis signals an end of an era, and it does not bode well for anyone. The near anarchy in Russia, the food riots in Indonesia, and the growing recession in Japan are signs of conditions spreading across the globe. And unfortunately, there is no sign that correct policy will soon be instituted anyplace. Capitalism erroneously is being blamed. No mention is made that no country today is truly capitalist in following a sound monetary policy. A lot of lip service is given to free trade, but with only casual observation one realizes that which is being promoted as free trade is internationalism and managed trade through organizations and programs such as NAFTA, the World Trade Organization, the IMF, the World Bank, foreign aid, subsidized exports, and a UN-directed foreign policy. Economic sanctions by those professing free trade are commonplace and growing. Today's protectionists rely on these programs in an effort to outwit their competitors, along with demanding currency devaluations in a futile effort to enhance exports. Markets inevitably devalue currencies that have been inflated by the monetary authorities. The degree depends on the amount of previous monetary inflation and political perceptions. But on the short run, countries frequently accelerate the devaluations in a competitive fashion in an effort to gain a competitive edge against their trading partners. This is why China, despite the denials, will likely accept the policy of official devaluation. But our concerns here in the Congress should be for the dollar. We should not be so arrogant as to dictate policies to others, since we have no authority to do so, whether it be Japan, Indonesia, Mexico, or Russia. We should resist this no matter how tempting it might seem. And we certainly should not use dollars to prop up other currencies or economies, whether it be Mexico or anyone else. Bailouts compound the problems and encourages others to mismanage their economies while expecting a bailout for themselves from Uncle Sam. But most importantly, it undermines the value of the dollar. Since returning to Congress in January of 1997, I have repeatedly warned that our monetary policy is seriously flawed and will eventually lead to a dollar crisis. This, in spite of the fact that the dollar has been riding high in American bonds, and up until recently our stock markets have been a haven for the ravaged world financial markets. Foreign central banks for years have been willing holders of our dollars, helping to finance our profligate ways, diminishing price inflation here at home by buying up more dollars than our own central bank. But conditions are changing. In spite of many reasons for capital to flow into dollar assets in the last few years, foreign central banks have dumped $85 billion of their U.S. bond holdings. Considering our large negative trade balance, it is not a surprise to see this happening. And as this dumping of U.S. dollars accelerates, more pressure will be put on the dollar. What can we expect from our illustrious central planners, the Federal Reserve? Just as difficult as it is for an addict to gradually cut back on drugs, economic planners refuse to accept the cutting back of credit creation the markets have become addicted to. Long life may be dependent on sound medical advice and drug abstinence, but feeling good on the short run drives the addict. Likewise, an economy feels good by perpetuating for as long as possible the easy credit that brought us the good times in the first place, while the long life of the currency, the economy, and the political system causes little concern. Because there is little interest for the long term in Russia and East Asia, chaos and political strife has prevailed. This we cannot afford in the United States. Today, essentially all politicians, economists, and investors are strongly urging the Fed to do what they do best: inflate the currency, arguing that a liquidity crisis must be avoided at all costs. All that is required, they say, are low interest rates. But this can only be achieved by creating new money even faster. And M3 is already growing at a 9% annualized rate. This is inflation and the source of the problem. And it appears the Fed is ready to accommodate. Central planning, Soviet style, is a known failure. But we have not yet given up on our type of central planning through a powerful and secretive central bank that dictates interest rates and amounts of credit available to the system. Fine-tuning and economic management has been left to the Fed. It is It is at its pinnacle of power. Ironically, a once gold standard free market proponent, Alan Greenspan, leads it. Let there be no doubt about it. The good times came with the generous credit creation and low interest rates, and Greenspan will yield to the politicians' pressure to continue the process. Turning off the money spigot and allowing the markets to work will never be seriously considered. But eventually, the markets will rule. Credit creation may lower rates for a time, but when confidence is undermined, an inflation premium will emerge and rates will rise regardless. Lack of demand for loans in Indonesia and elsewhere in East Asia has not lowered rates. In a country with a collapsing currency, rates can and will rise, especially if inflating the money supply is the tool of choice in an effort to stimulate the economy.